Hello and welcome. You tune in to Buy and Sell now. I'm Ankita Saxena and with me is Kavita Thaplayal. In the next 1 hour, we'll take you through all that's transpiring in the markets and more. And remember, we are in the thick of earnings season and we are talking about an earnings candidate that is in focus today on the back of its results. We have the management of LIC Housing who will be joining us. Let's take a look at the numbers. Its overall Q4 has been rather neutral to positive. But let's talk to the management and get a sense on color on the numbers. Tribhuwan Adhikari, who's the MD and CEO, LIC Housing Finance, is joining us now. Hello, Mr. Adhikari. Good morning. Thank you so much for joining us today. Mr. Adhikari, firstly, the loan growth remains rather weak at 4% on a year-on-year basis. What are the structural challenges impacting disbursement growth? Could you give us some color on that?
Well, as such, no such structural challenge as well. Vartik, as you know, we are prominently an IHL based company, right? So this year, after the rate cut started from February onwards, there was a lot of competition in the market. The banks, their rates are linked to the repo. So, moment the repo rate is cut, their rates come down. Our rates are not repo linked. We have our own, we call the PLR. We have an own PLR, and that is dependent on the cost of funds at which the cost of the borrowing which we do. So there was a lot of pressure in the beginning of the year, Q1, Q2, and also Q3 also. But Q4 we have picked up. Q4 we have shown a double-digit 10% disbursement growth in Q4. So partly the low, I would say 4% growth in overall disbursement and portfolio was because of the pressures of Q1, Q2, and Q3.
That's right. Mr. Adhikari, individual home loan growth slowed to almost 3.6%. Now, is the slowdown due to demand competition or internal strategy changes?
No, the internal strategy, see, as I said, we are an IHL-based company and we focus on IHL only 82% of my business. This year it has come down from 85 to 82. We are trying to diversify to other, I would say, yield creative portfolios like LAP and LRD. So there has been a 3% downtick in the composition of the IHL to the overall business. But still, we are predominantly an IHL company, and IHL, we are competing with banks, right? So there's a big rate war going on. Banks, since their cost of funds are slightly lower than the cost of funds we are able to garner. So the competition, I think, is the reason why there is a lot of, I would say, pressure, competition on the retail front, because basically retail is all IHL for us. Though LAP and LRD is growing this year, our LAP LRD share has gone up to about 15%, up from 12% of last year. But still, this will take time. This will take time. Our predominantly retail book will have to face competition from banks, especially. And we will need to recalibrate our strategy as to how we need to grow in retail without losing margins. In the beginning of the year, I had very clearly said, given a choice between AUM growth and protecting margins, we would protect margins. That is what we have done. Our margins are fairly intact, right? This quarter, the NIM is at 2.8, very well within the guidance of 2.6 to 2.8, which we had given. So margins, we have been able to protect despite the intense competition in the market.
And well, sir, your NIMs also improved this quarter. How sustainable is the current margin trajectory and the rate volatility?
Well, as far as the rates are concerned, I feel as of now, I think there is no risk of any downtrend in the risks, considering the volatile situation, the global economic profile situation, the geopolitical situation around the world, with all that is happening in West Asia, etc., etc. So honestly, I don't see rates coming down. RBI also has indicated that in its last MPC. So let us wait and watch. It will be difficult to predict what the NIMs are going to be for the year in view of the ongoing West Asia crisis and the geopolitical situation. So this year, I would say, stick my neck out and give you a yearly guidance on NIMs. What I would do, I think I would give you a guidance for the quarter. And for the quarter, I think I would stick to my last year's guidance of, I would say 2.6 to 2.7 for the quarter. Let's see how it goes in the quarter, how the geopolitical scenario plays out. And then in the in the second quarter, beginning of the second quarter, I think we'll be in a better position to give you guidance on NIMs.
All right. Now, with the credit cost moderating to 9 BPS and asset quality improving, should this be seen as the normalized trend going forward? And which borrower segments are driving the asset quality recovery?
Well, if you look at our stage 3 book, it is, I think, more or less 50-50 between our construction finance, or what we call the project finance, and the retail book. And the asset quality has no doubt been improving, yes. And I am very, very, very sure going forward, this trend is going to continue. Our GNPAs and NNPAs are going to come down. They have already come down this year. Last year, we were at 2.47. This year, we are at 2.15. NNPA from 1.22 has come down to 1.08. So this improving trend in asset quality will continue. In fact, I would hazard a guess and say that probably going forward, the intensity in improvement in asset quality would improve further in view of all the hard work that has gone in the last financial year. Some of the big ticket loans which are outstanding as NPAs in our books, the kind of resolutions which or the discussions and negotiations which have taken place in those, I think you will see Q1 onwards, Q1 of the current fiscal onwards, you will see the asset quality improving much, much, much further.
Right. Also, what initiatives are being taken to accelerate the retail loan growth and regain market share?
Yes, few strategies which are quite different from what we've been doing so far, right? One is all this long 36-year history, we have always looked at organic growth. That means we have relied on our own sourcing. This year, we are looking at co-lending as one of the means to increase our book size and our disbursement size also. So our co-lending policy is almost finalized, and I think very shortly we will be starting this co-lending business, wherein we purchase pools of business from other institutions. That is one. Number two, we are also increasing our feet on the street as far as retail lending is concerned. We have received a sanction of an additional hire of 200 odd people, which will happen in Q1 of this year. And these will all be put into the marketing vertical of the company. They will give a boost to the marketing, retail marketing push. Number three, we are also looking at all this long, we have been reliant on our own marketing intermediaries or so-called agents to do source our business for us. Apart from that, of course, we have two corporate agents. One is our own subsidiary, LIC Housing Finance, Financial Services Limited, and the other is a corporate agent. This year, we are also looking at onboarding business aggregators, right? So these are basically companies who aggregate business and then give it to us for processing and for consideration. So this aggregator business is another thing we are looking at. And overall, we would also be pushing our marketing teams to take advantage of whatever opportunities are available in the market. So this in all is the strategy to give a push to the retail business of the company in the current financial year.
All right. You had indicated a strategic shift towards floating rate borrowings. Now, what is the targeted mix, fixed versus floating borrowing mix over the next 18 months, maybe?
Well, last year when we started, I think our fixed was 55% and floating was 45%, right? Now, when we've ended this year, I think our fixed is at 48 and our floating is at 52. So we have shifted our borrowing from the fixed to the floating, and that has given us sort of benefits in our NIMs and also in our spreads. But going forward, it would all depend because see, banks also have their own limitations in lending, right? Right now, I think our borrowing from banks would be approximately about 38 to 40% total borrowing book. 38 to 40% of our borrowing book is borrowing from banks. So banks also have their limitations, and there also is a stipulation that we have to in a 3-year period, we have to do a certain percentage of our borrowing through NCDs. I think it is 25%. So looking into all that, though our intention would be to go in for floating rate borrowings, let us see how far we can stretch it. We have already done it last year. Let's see this year how far we can stretch it.
Right, Mr. Adhikari, also at the current valuation levels and moderate growth, would management consider any buybacks as a capital allocation tool?
No, this is not yet on the anvil. There are certain discussions on how we can reward shareholders, but this is definitely not yet neither in the discussion stage nor in the thought process.
All right, last question before we let you go, Mr. Adhikari. How does management plan to balance growth versus profitability over the next 12 to 18 months?
Well, honestly, last year our entire focus was on profitability, protecting our spreads, protecting our margins. Even if we had to take I would say, a step back from the growth front. Yes, that was the entire strategy last year. Somehow, yes, the growth has not played out. Portfolio growth has been 4% year on year, but we've been able to protect our spreads and our margins largely. So that has resulted in an overall increase in profitability by about 3%, I think. This year, I think going forward, as I said, the situation is very, very volatile right now, right? I'm not very sure what the demand is going to be with the West Asia crisis going on, the energy crisis already in hand, the rupee sort of falling, yes. The AI impact not yet fully felt in India at the moment. God knows when it is going to come. So all these factors are creating a situation where it's very difficult to put a sort of have a very long view on events. Though, of course, as a company, we will try to balance this year. We will try to balance growth and profitability. I try to maintain the NIMs at somewhere around about 2.5, 2.6, probably higher also. But that would all depend on how this entire geopolitical and the socioeconomic situation plays out. So, of course, the focus of the company will this year definitely try to show a growth. We'll stick to our guidance of double-digit growth, both in the disbursement and in the AUM or the loan book. And profitability, yes, we will try to maintain our margins at somewhere around about 2.5 to 2.6 this year. If all plays out properly, if some crisis develops, then actually we need to have a relook at whatever guidance we are giving.
All right, Mr. Adhikari, on that note, thank you so much for joining us and giving us the roadmap ahead for LIC Housing. We'll let you go on that note. And it's time for us to slip into a short break. Don't go anywhere, because after break, we are getting one more management of Concord Control Systems after the break to weigh in on the numbers. So stay tuned. We'll be right back.